Every morning, Ken Leech walked into one of the most powerful investment firms on the planet and did something that would eventually cost ordinary Americans over $600 million. He placed his trades. Then he waited. By 3 p.m., he knew which ones made money, and which ones didn't. And that's when the real decision happened. Not what to buy, not what to sell, but who deserved to win. And who was going to take the loss. For nearly 3 years, he made that choice. Every single day. And the people on the losing end had no idea it was happening. This is the story of the most brazen betrayal in American bond market history, and how it took the SEC, 2 federal agencies, and a guilty plea just 8 days ago to finally stop it. Western Asset Management Company, WAMCO, isn't a name most people know. But if you have a pension, a 401k, or a bond mutual fund, there's a real chance they were managing your money. At their peak, they controlled over $400 billion in assets. That's more than the GDP of most countries on Earth. They were one of the most respected fixed-income managers in the world. And sitting at the top of that empire, co-chief investment officer, was Ken Leech. Leech wasn't just good at his job. He was considered a legend, a bond market genius, the kind of manager that institutional investors, pension funds, teacher retirement systems, municipal employees, specifically asked for by name. The Illinois Municipal Retirement Fund trusted him. The Chicago Teachers Pension Fund trusted him. The Kern County Employees Retirement Association trusted him. Hundreds of thousands of ordinary Americans, through mutual funds with tickers WATFX and WACPX, trusted him. And from January 2021 through October 2023, according to federal prosecutors and the SEC, he was robbing them. Now, before I show you exactly how he did it, I want you to hold 3 questions in your mind, because by the end of this video, all 3 are going to hit very differently. First, how do you steal $600 million without moving a single dollar out of the firm? Second, who signed off on the system that made this possible? And third, if this happened at one of the most scrutinized investment firms in the world, how many others are doing this right now? Here's how cherry-picking works, and why it's so hard to catch. Every morning, a portfolio manager like Ken Leech places a block trade. Let's say he buys $50 million worth of treasury bonds on behalf of the firm's clients. At the time of purchase, that trade sits in a holding account, It hasn't been assigned to any specific client portfolio yet. By law, the allocation, deciding which clients get which trades, is supposed to happen at the time of the trade, or very shortly after. The whole point is to prevent exactly what Ken Leech was doing. Because here's the thing. Bond prices move during the day. By 3 p.m., you know whether that $50 million trade made money or lost money. If you wait until the end of the day to allocate, you now have a choice. You can send the winners to your favorite clients and dump the losers on everyone else. According to the indictment, that's precisely what Leech did. For nearly 3 years. He ran what prosecutors call a 2-tier system. On one side, his macro opportunities portfolios. These were his elite accounts, sophisticated institutional clients who were sold on Leech's best ideas. They got the winning trades, day after day, month after month. On the other side, the core and core plus strategies. The funds that ordinary teachers and city workers and retirees had their retirement savings in. WATFX, ACPX. They got the losing trades. Over $600 million in gains went to the favored portfolios. Over $600 million in losses landed on the disfavored ones. A $1.2 billion swing. Manufactured. Deliberate. Hidden inside the normal noise of bond market trading. And because bond markets are complex, because trade allocations are buried in back-office systems, because Ken Leech was a legend who nobody questioned, it worked. For nearly 3 years, it worked. But here's the part that should make you genuinely angry. This wasn't invisible. The warning signs were there. And the people whose entire job was to catch exactly this kind of fraud either missed it, ignored it, or looked the other way. We'll get to that. But first, let me show you exactly who was on the losing end of Ken Leech's morning routine. The Chicago Teachers Pension Fund manages retirement savings for over 60,000 active teachers and 25,000 retired educators in the Chicago public school system. People who spent their careers in underfunded classrooms, grading papers at midnight, buying supplies with their own money, trusting that at least their retirement was safe. The Illinois Municipal Retirement Fund covers hundreds of thousands of state and local government workers, firefighters, librarians, public health nurses, people who chose public service over private sector salaries, in part because of the pension security it promised. The Kern County Employees Retirement Association workers in Bakersfield, California. More teachers, more first responders, more people who had exactly zero say in who managed their retirement money. And then there were the retail investors. Hundreds of thousands of ordinary Americans who had money in WATFX or WACPX, Western Assets, Core and Core Plus mutual funds. Some of them chose those funds specifically because of Ken Leech's reputation, because their financial advisor recommended them, because the performance record looked solid. What they didn't know, what none of them could have known, is that the performance record was, in part, a lie. The real returns were being systematically siphoned away. Their losses weren't bad luck or bad markets. They were manufactured, intentionally assigned to them so that someone else's portfolio could look better. One former pension fund trustee, after the charges were announced, said something that stuck with me. He said, "We hired the best in the world. We did everything right, and it still happened." That's the part that doesn't get talked about enough. These weren't naive investors who ignored red flags. They did their due diligence. They hired a legend. And that legend was stealing from them. So how does something like this actually get caught? Not quickly, it turns out. The SEC's Enforcement Division uses statistical analysis to identify unusual patterns in trade allocations. When one manager's favored accounts consistently receive first-day gains at rates that are statistically impossible to explain by chance, that's a red flag. And eventually, that's exactly what they found. The investigation into Western Asset Management and Ken Leech began quietly. Regulators started pulling trade records. They looked at the timing of allocations. They compared the performance of the macro opportunities portfolios against the core and core plus strategies, day by day, trade by trade. What they found was staggering. The statistical gap between the favored and disfavored portfolios wasn't a matter of better investment decisions. The winning trades were being assigned to the same accounts, consistently, at rates that would be virtually impossible if the allocation process were random or merit-based. In November 2024, the DOJ and the SEC moved simultaneously. Ken Leech was charged with securities fraud, investment advisor fraud, commodity trading advisor fraud, commodities fraud, and making false statements. WAMCO itself was charged with failure to supervise. Leech pleaded not guilty in December 2024. His legal team argued the allocations were legitimate, that the macro opportunities portfolios were genuinely his best ideas and deserved preferential treatment. But then something changed. 3 days before he was supposed to stand trial, with federal prosecutors ready to present 2 years' worth of evidence and witnesses prepared to testify, Ken Leech made a decision. He called his lawyers. And on June 12, 2026, he walked into Manhattan Federal Court and changed his plea. Not guilty to guilty. But here's the twist. What he admitted to wasn't the fraud itself. Ken Leech pleaded guilty to obstruction of justice, specifically obstructing the SEC's investigation into the cherry-picking scheme, not to the underlying securities fraud. not to the $600 million theft itself, just 8 days ago. This is a move defense attorneys sometimes call a plea to a lesser. By pleading to obstruction rather than the fraud charges, Leech's legal team potentially limits his sentencing exposure. The fraud charges carried far heavier penalties. Obstruction is serious, AU, but it's not the same as admitting you systematically robbed pension funds for 3 years. At the same time, AEU. June 5th, 2026. AEU. Western Asset Management agreed to pay a $100 million civil penalty to the SEC to resolve charges that they failed to properly supervise Leech. $100 million sounds like a lot, until you remember that $1.2 billion in gains and losses were manipulated on their watch. That's roughly 8 cents on the dollar. As of this recording, Leech has not been sentenced. The victims in WATFX and WACPX are pursuing class action lawsuits. Several pension funds have already terminated their relationship with WAMCO. And Franklin Resources AO, the parent company that owns Western Asset AO, has seen their stock take significant pressure as institutional clients have walked. But for the teachers in Chicago, and the firefighters in California, and the retirees who held WATFX in their 401ks, $100 million in fines doesn't undo 3 years of systematically assigned losses. That money is gone. And the person who took it just pled guilty to hiding the evidence, AU, not to the taking itself. Here's the part of this story that I can't stop thinking about. Ken Leech wasn't operating in some shadowy offshore account. He wasn't running a fake company or forging documents. He was sitting in one of the most regulated, most scrutinized, most compliance-heavy industries in the world, and he did this inside the normal machinery of a legitimate firm for nearly 3 years, at a scale of over $1 billion. And the system that was supposed to catch it, the internal compliance team, the external auditors, the SEC's routine oversight, didn't catch it until the statistical pattern became impossible to ignore. So here's the question that keeps me up at night, and it should keep you up too. The SEC brought 456 enforcement actions in fiscal year 2025 alone. They recovered $17.9 billion in penalties and disgorgement. Those are record numbers. And yet AU, a man managing $400 billion in client assets, ran a daily theft operation for nearly 3 years before anyone looked closely enough. How many Ken Leeches are still out there right now? How many managers at firms you've never heard of are making the same 3 p.m. decision, winners here, losers there, with your money? The answer, based on how this industry actually works, is almost certainly more than one. That's not cynicism. That's the lesson that every major financial fraud in history teaches us, if we're willing to listen. The next video on this channel is going to go deeper into exactly how the SEC's trade allocation monitoring system works, and why it still has gaps that sophisticated players know how to exploit. If that's the kind of investigation you want to follow, you know what to do. Ken Leech, Western Asset Management, $600 million. 3 years. A guilty plea 8 days ago. Remember those 3 questions I asked at the start? How do you steal $600 million without moving a single dollar? You don't move it, you redirect it, one trade at a time, hidden inside the complexity of bond allocation. Who signed off on the system that made this possible? WAMCO's compliance department, which is now paying $100 million for that failure. And the last one, the one that matters most. If this happened here, who's next? I'll see you in the next one.